So I'm trying to wrap my head around this massive contradiction today.
Yeah.
Because if you look at the U.S. stock market right now, it is, hovering right near all-time highs.
Right, it's barely budged.
Yeah, exactly. But then at this exact same moment, we've got something like 15,000 U.S. troops locked in this highly violent naval conflict. Oil is just boiling over $100 a barrel, and the global economy is flashing these warning signs that, we haven't seen since the 1970s. So welcome to Monday, May 4, 2026.
It really is the defining paradox of the moment, isn't it? We are looking at this global dashboard where half the warning lights are just short-circuiting, and yet somehow, the engine just keeps running. But the strain on that engine is becoming, well, it's becoming unbearable.
And that's exactly the mission for today's deep dive. We are taking this massive stack of live updates, market reports, macroeconomic data, and we're going to try to trace all the invisible wires connecting these seemingly random events for you.
Yeah, because they are definitely connected.
Completely. We're going to show you how a military blockade in the Middle East is fundamentally tying the hands of the new leadership coming into the Federal Reserve, and how that exact tension, that specific pressure, is creating a market environment that is bizarre enough for a video game retailer to attempt a $56 billion corporate takeover of a massive e-commerce giant.
Which is still just wild to say out loud.
Yeah.
And to unpack all of this, we are drawing from, well, a really eclectic mix of sources today. On the geopolitical front, we're pulling live, on-the-ground updates from CBS News, The Guardian, and the Jerusalem Post.
Right, the hard news.
Exactly. And then to understand the actual mechanics of the economy, we are relying on analysis from the Teller Window, which, for those who don't know, is the New York Fed's publication. And we're pairing that with a really comprehensive structural divergence report.
Plus all the hard market data, right?
Yeah, from Zacks, Motley Fool, and Trading Economics. So we're grounding the whole conversation in actual, tangible numbers.
Now, before we really get into the weeds, I do need to make a quick, very earnest promise to you. The intelligence we're unpacking today touches on some highly charged political action.
A very charged.
Yeah, specifically the military maneuvers and economic strategies of the Trump administration, along with the diplomatic demands and the military responses of the Iranian government. Our only mission here is to act as impartial guides.
Right, we are absolutely not here to take sides. Left, right, center, doesn't matter.
Not at all. We are not validating any political narrative. We are here strictly to impartially lay out the data, the facts, and the ideas presented in the original source material. We just want you to see the whole board without any spin.
And that goal of clarity is so important right now because the environment is just saturated with noise. And to find that clarity, I think we have to start at the physical epicenter of the disruption. We have to look at the water.
Yeah, let's look at the immediate trigger dominating the news cycle today, which is Project Freedom.
Right.
So over the weekend, President Trump took to Truth Social to announce the launch of this U.S.-led operation. And in the announcement, he framed it as this humanitarian gesture. He said it's strictly designed to guide stranded commercial ships out of the Persian Gulf and safely through the Strait of Hormuz. But, when you look at the sheer military footprint they've deployed, the word humanitarian feels like it's being stretched to its absolute breaking point.
Oh, it's stretched beyond the breaking point. The scale detailed in the CNTCOM briefings is staggering. U.S. Central Command, under Admiral Brad Cooper, has positioned roughly 15,000 active duty service members for this operation.
Wait, 15,000? Just for this escort mission?
Yes. 15,000. You do not move 15,000 troops over 100 land and sea-based aircraft and multiple guided missile destroyers just to, politely escort a few freighters out of the Gulf.
No, you deploy that kind of force when you are establishing a very hard perimeter.
Yeah.
And the briefing also heavily emphasizes the use of multi-domain unmanned platforms. In a naval context, what does that actually look like on the water today?
Basically, it means they are completely saturating the airspace and the sea surface with autonomous tech. We're talking about long-endurance aerial drones providing constant surveillance of the coastline. You've got surface vessels equipped with advanced radar and sonar arrays, and crucially underwater autonomous vehicles that are explicitly hunting for deep-sea mines.
Right, the mines are the real terror for these commercial ships.
Exactly. The stated objective from the U.S. is to establish overwhelming tactical defense, maintain a safe maritime corridor, and basically give commercial captains the real-time intelligence they need to navigate what is essentially a lethal obstacle course.
But the narrative coming out of Tehran is fundamentally incompatible with that U.S. objective, right? Yeah. Iran's military central command, specifically Major General Ali Abdullahi, has unequivocally stated that any foreign armed force entering the Strait of Hormuz will be targeted.
And they aren't mincing words.
Not at all. The Islamic Revolutionary Guard Corps, the IRGC, issued a parallel warning that any vessel, commercial or military, attempting to transit without their explicit permission and without adhering to their specific transit protocols is going to face serious risks and be met with force.
Which creates an impossible situation for global logistics. I mean, you have to picture the Strait of Hormuz. It's only about 21 miles wide at its narrowest point.
Wow, that is narrow.
It is. And the actual shipping lanes in either direction, they're only 2 miles wide. It is a severe geographical choke point.
It's like, okay, think of it like a vital, multi-lane tunnel connecting a major city to the outside world. And right now, Project Freedom is acting like this heavily armed traffic cop trying to clear a multi-car pileup inside that tunnel. But the tunnel is also rigged with explosives, and there are snipers taking shots at the tow trucks.
That's a very vivid, very accurate analogy.
We hear Trump calling this a humanitarian gesture and a mini-war, almost in the exact same breath. Meanwhile, Iran's foreign minister, Abbas Araqi, went on the record calling the U.S. operation Project Deadlock. So how does this battle over semantics translate into actual physical risks for these massive commercial vessels?
Well, let's view this through the lens of, say, a maritime insurance underwriter sitting at a desk at Lloyd's of London. To that underwriter, the political semantics are completely irrelevant. The physical risk is literally all that matters.
Right, they just want to know if the ship is going to sink.
Exactly. So you have U.S. Treasury Secretary Scott Bessent going on television insisting the U.S. has absolute control of the strait. But simultaneously, the IRGC is claiming the U.S. narrative is entirely false and that they control the waters.
So who does the insurance guy believe?
Neither, really.
Yeah.
Because if you are underwriting a cargo ship carrying hundreds of millions of dollars in goods, you cannot insure that voyage based on a politician's claim of absolute control. The mere presence of unsurveyed sea mines means the risk of a catastrophic loss is effectively infinite.
The premiums just explode.
They skyrocket to the point where the voyage becomes economically unviable. No one will pay the insurance. And that, functionally, is the definition of a blockade.
And the violence we've seen over the last 24 hours proves that this risk isn't just theoretical. Our sources detail some really intense kinetic engagements on the water today, May 4. The U.S. military did successfully guide 2 U.S.-flagged ships through the strait.
They did manage that, yes.
Yeah. The shipping giant Maersk confirmed that one of those vessels was the Alliance Fairfax, which had literally been trapped in the Gulf since the broader conflict escalated back in late February. But getting the Fairfax through required severe force.
Very severe. Admiral Cooper confirmed that during this transit, U.S. forces engaged and actually sank 7 Iranian small, fast boats.
7 of them.
7. These are those highly maneuverable speedboats the IRGC uses all the time to swarm larger, much slower merchant vessels. And it wasn't just the boats. The U.S. had to deploy defensive munitions to intercept and defeat multiple incoming cruise missiles and drones that were targeting the maritime corridor.
And the conflict is aggressively spilling over the borders, too. It's not just ship-to-ship skirmishes in the strait anymore. The United Arab Emirates, which is obviously a critical U.S. ally and this massive economic hub, they reported a major aerial assault today.
A really significant escalation.
Yeah, their air defense networks had to engage a barrage of 15 Iranian missiles. And specifically, 12 of those were ballistic missiles, along with 3 cruise missiles and 4 drones.
And we need to pause on that for a second. Intercepting a ballistic missile is a massive escalation compared to fighting off a fast boat.
How so? Like, technically speaking.
A ballistic missile has a parabolic trajectory. It literally leaves the atmosphere and comes down at hypersonic speeds. The fact that the UAE is dealing with this level of ordnance just shows how rapidly the whole theater of war is expanding.
And some of those strikes actually circumvented the defenses. The sources explicitly detail a fire breaking out at the Fujairah oil industry zone in the UAE, which resulted in injuries to 3 Indian nationals working at the facility.
Which is huge, because Fujairah is the largest commercial oil storage zone in the UAE.
Right, so targeting it sends a very clear, very violent message about how vulnerable that infrastructure is. And on top of that, an ADNOC, an Abu Dhabi National Oil Company tanker, was targeted by 2 drones, and South Korean media is reporting an explosion on one of their commercial cargo ships right in the strait.
And they're still trying to figure out what happened there.
Yeah, they're investigating whether it was a targeted missile strike or if the ship actually hit a sea mine.
When you look at the sheer volume of ordnance flying through the air, The diplomatic tracks that are occurring in the background just feel incredibly disconnected from the physical reality.
Well, let's explore those diplomatic tracks impartially, because both sides are proposing terms that the other finds basically impossible. Reports indicate that Iran submitted a 14-point peace proposal using Pakistani diplomats as mediators.
Right, the 14-point plan.
Yeah. And this plan reportedly demands an end to the war within 30 days, the total lifting of all U.S. sanctions, an end to the blockade on Iranian ports, the complete withdrawal of U.S. military forces from the region, and an end to Israel's military operations in Lebanon.
And President Trump, in an interview with Cannes News, categorically rejected that plan. He stated it was not acceptable, arguing that Iran had not yet paid a big enough price. So you have these maximalist demands from Tehran meeting a maximalist rejection from Washington.
We also see the U.S. and its Gulf allies attempting to leverage international law. They're drafting a UN Security Council resolution that demands Iran cease laying sea mines and immediately disclose the coordinates of the ones they've already deployed.
But as we've seen with similar resolutions earlier in this conflict, the likelihood of it surviving a veto from nations allied with Iran, like Russia or China, is incredibly low. It's basically zero.
So it's largely symbolic at this point.
Pretty much. The only tangible diplomatic success noted in our sources today was incredibly narrow in scope. Pakistan managed to facilitate the return of 22 crew members from the Tuska, which is an Iranian ship that the U.S. had previously seized.
Which is obviously great for those 22 individuals and their families.
Absolutely. But from a geopolitical standpoint, it does nothing to alter the strategic calculus of the blockade itself.
Right. Taking out a few fast boats and rescuing a few dozen crew members doesn't clear the fundamental risk of that waterway. And when shipping companies look at that impossible risk environment, they simply stop moving cargo, which is exactly why, halfway across the world, we are seeing this violent, immediate reaction in the commodities market today.
Because the Strait of Hormuz is the single most important energy choke point on the planet. I mean, approximately 20% of the entire world's daily oil consumption flows through that narrow stretch of water.
When you choke off 20% of the lifeblood of the global economy, the financial reaction is going to be instantaneous. Let's look at the hard numbers from today. Brent crude, which is the international benchmark for oil, it leaked 5.8% today to settle at $114.44 barrel.
And remember the context there, it actually touched $120 earlier in the week.
Yeah. And the U.S. benchmark, West Texas Intermediate, or WTI, is sitting right around $103 a barrel. Before this conflict really escalated in February, Brent was sitting comfortably around $70 a barrel.
And a price shock of that magnitude happening that quickly, it just acts as a wrecking ball through the global supply chain. Oil isn't just the gasoline you put in your car. It is the foundational input for plastics, pharmaceuticals, agriculture, and crucially, the transportation of every physical good you buy.
Right. Everything gets delivered on a truck or a ship that burns fuel.
Exactly. When oil jumps from $70 to $114, the cost to manufacture and deliver absolutely everything spikes.
I really want to focus on a word here that has been terrifying central bankers and economists, and it heavily features in the structural divergence report we're analyzing today: stagflation. I want to make sure we truly understand the mechanics of this, because it sounds like, dry economic jargon, but the reality is deeply painful for the average person.
It is incredibly painful.
Think of stagflation like a human body suffering from two contradictory diseases at the exact same time. You have a raging fever, which is inflation prices are running incredibly hot. But you also have severe anemia, which is economic stagnation. Your muscles are weak, growth is contracting, and unemployment is rising.
That analogy is highly accurate because the traditional treatment for one condition actively worsens the other.
How does that work in practice?
Well, usually if the economy is stagnant and weak, central banks lower interest rates to pump money into the system and stimulate growth. But if you do that while you have a raging inflation fever, you just pour gasoline on the fire and prices spiral completely out of control.
Right, you make the fever worse.
Exactly. Conversely, to cure the inflation fever, you raise interest rates to cool the economy down. But if the economy is already anemic and contracting, raising rates can kill the patient entirely and trigger a massive recession.
You're just stomping on the brakes.
Yeah.
And the April 2026 Institute for Supply Management, or ISM, manufacturing report provides this chilling, empirical proof that the U.S. economy has contracted this exact disease.
The divergence in that data is unprecedented.
It really is. This report surveys purchasing managers across the country, the people actually buying the raw materials to run American factories. And the prices paid index, which measures exactly what it sounds like, the cost of raw materials, surged 25.6 points to a four-year high of 84.6. The cost to acquire the basic building blocks of commerce is just exploding.
Right, so that is the fever you were talking about. And then you look at the anemia. In the exact same report, the employment index contracted to 46.4. And in the ISM methodology, any number below 50 indicates a contraction.
So, okay, let me unpack this. Companies are paying through the nose for raw materials because of the oil spike, but they aren't actually growing their businesses. So they are slamming the brakes on hiring and actually cutting their workforce.
Yes, they are trapped in a severe margin squeeze. If your cost to produce a widget doubles overnight, you basically have two choices. You either absorb that cost and go bankrupt, or you pass that cost onto the consumer by raising the price of the widget.
Let's use a tangible corporate example from our sources to show how this margin squeeze plays out in the real world because it's fascinating. Let's look at Tyson Foods. They just released their earnings, and the underlying mechanics are wild.
They really are.
Tyson sold less beef by volume in their fiscal second quarter. Like, the actual tonnage of food moving from their processing plants to grocery store shelves shrank. Consumers are buying fewer steaks because their budgets are completely stretched.
Which is a very clear indicator of stagnation and a weakening consumer base.
Right. But because Tyson's underlying costs are so astronomically high right now, driven by everything from transportation fuel to feed costs, they aggressively hiked the price of the beef they did sell by 11.5%.
A massive price hike.
And because of that price hike, their overall revenue actually beat Wall Street estimates, coming in at $14.31 billion.
And that is the insidious nature of inflation in a corporate earnings report. The headline number, that $14.31 billion in revenue, it looks like a success to an algorithmic trading bot. But the fundamental reality is that the volume of actual goods moving through the economy is shrinking. The consumer is bearing the absolute brunt of the cost, paying significantly more money for less food.
Less steak for more money. And then on the flip side of that dynamic, look at Norwegian Cruise Line Holdings. Their stock dropped 5% today. They actually beat their profit expectations for the current quarter, but they had to severely slash their forward guidance for the rest of the year.
Because of the fuel.
Exactly. You cannot run a fleet of massive ocean liners without burning immense amounts of fuel. And the cost of that fuel is just destroying their future margins. Plus, their customers are actively pulling back on travel demand to Europe because of the geopolitical instability and the sudden trade warfare we're going to discuss in a minute. So Norwegian is seeing their costs explode while their customer base retreats.
It creates a structural trap for the policymakers at the Federal Reserve. And we heard this articulated explicitly today in a speech by New York Fed President John C. Williams.
What was his message to the markets today?
Well, he highlighted the Personal Consumption Expenditures Price Index, the PCE. This is the specific metric the Federal Reserve prefers to use to measure inflation. The Fed's mandated target is always 2%.
Right, that's the golden number.
Yeah. But Williams noted that the PCE is currently running at 3.5%. And crucially, he explicitly stated that a full percentage point of that 3.5% is driven entirely by the combination of new tariffs and the Middle East energy crisis.
I look at this and I just see a terrifying lack of control. I mean, the Federal Reserve's primary tool is the interest rate lever, right? They manage the cost of borrowing money. But Jerome Powell can't deploy an aircraft carrier to the Strait of Hormuz to clear sea mines, and he can't drill an oil well in Texas to magically increase supply today. The root causes of this specific inflation spike are entirely outside the jurisdiction of monetary policy.
Which is exactly why the transition of power happening at the Federal Reserve right now is causing such violent tremors in the financial system.
The timing is almost unbelievably fraught. The term of the current Fed chair, Jerome Powell, officially expires in just over a week, on May 15th, 2026.
Yeah.
And President Trump has officially nominated former Fed Governor Kevin Warsh to succeed him. Why does this specific individual, Kevin Warsh, taking the helm at this specific moment, change the entire calculus for Wall Street?
Well, to understand the impact of Kevin Warsh, you really have to understand the deeply ingrained expectations Wall Street have been operating under for the last 6 months.
What were they expecting?
Throughout early 2026, the dominant narrative, which was heavily pushed by the Trump administration's growth agenda and desperately hoped for by corporate America, was that a new Fed chair would step in and immediately initiate a cycle of rapid interest rate cuts.
Because the market is just addicted to cheap money.
Completely addicted. Low interest rates make corporate borrowing virtually free, they make mortgages affordable, and they push investors into the stock market because they can't get any yield from savings accounts.
But Kevin Warsh's professional ideology does not align with that narrative of cheap money, does it?
Not even remotely.
Yeah.
When you analyze Warsh's tenure and his historical writings on monetary policy, he is deeply, fundamentally hawkish.
What does that mean in practice?
It means he is a staunch defender of central bank independence. He is historically highly resistant to political pressure from the White House to juice the economy. More importantly, he represents a higher-for-longer commitment to eradicating inflation. If inflation is running at 3.5% and oil is spiking, Kevin Warsh is not the type of central banker who will cut interest rates just to make the stock market happy. He will hold rates painfully high to crush demand until inflation is dead.
And the bond market is already doing the math on this Warsh reality check. Let's dive into the mechanics of the bond market for a second, because this is where the abstract theories of central banking translate into the actual cost of living for everyday people.
Yeah, the bond market doesn't lie.
It doesn't. The bond market is essentially the global pricing mechanism for borrowing money. If investors believe inflation is going to stay high and the Fed is going to keep rates high to fight it, they demand a higher return, a higher yield, to lend the U.S. government money. Today, the yield on the 10-year Treasury note violently spiked to 4.45%. Before this crisis in Iran erupted, it was sitting at 3.97%.
And that 48 basis point jump, I know it might sound like a tiny fraction to a layperson, but in the fixed income world, that is a massive, aggressive repricing of risk. And the 10-year Treasury yield is the foundational bedrock upon which almost all other debt in the global economy is priced.
Exactly. So if you're listening to this and wondering, why you should care about a Treasury yield, just look at the housing market. Mortgage rates are inextricably linked to that 10-year yield. Because of this spike, our sources show the average 30-year fixed mortgage is currently hovering around 6.30%.
Which just acts as a massive anchor on the housing market. It freezes inventory completely.
Right, because nobody wants to move.
Exactly. People who locked in a 3% mortgage a few years ago refused to sell their homes because buying a new one at 6.30% would literally double their monthly payment. So supply dries up, making housing totally unaffordable for new buyers.
And it's not just mortgages, right? It's auto loans. It's the credit cards used by the consumer who is already paying 11.5% more for that Tyson beef. It's the small business owner trying to take out a commercial loan to float their operations because their raw material costs just spiked 25 points on the ISM index. We've got Fed President Williams hoping for 3% inflation this year as a base case, but with Kevin Warsh coming in and oil boiling over, isn't the bond market essentially waking up, screaming, and admitting that the era of cheap capital is completely dead for the foreseeable future?
Yes, absolutely. The bond market is stripping away all the optimistic rhetoric. If the Fed prioritizes its institutional credibility, meaning it refuses to let 3.5% inflation become structurally entrenched in the economy, it has to accept the collateral damage. And the collateral damage is that the cost of capital for everyday life will remain punitively high.
But wait, if I'm looking at my 401k today, I am incredibly confused. I mean, if borrowing money is astronomically expensive, if manufacturing is actively contracting, and if a major regional war is shutting down 20% of the world's oil supply...
Why is the market up?
Exactly. Why did the S&P 500 just recently come off an all-time historical high? It slipped a fraction of a percent today, down 0.4%, but structurally, it is sitting at the summit of the mountain. How does that make any rational, fundamental sense?
Well, it makes sense when you fundamentally deconstruct what the S&P 500 actually is in 2026. The S&P 500 is marketed to people as a broad reflection of the 500 largest companies in the U.S. economy.
Right.
But that is no longer mathematically true. The structural divergence report we are analyzing today highlights a terrifying level of concentration. The U.S. stock market is currently being propped up by an unprecedented accumulation of wealth in one single sector: information technology.
Give me the exact weighting. Just how top-heavy is this index right now?
The information technology sector now accounts for 32.9% of the entire S&P 500.
Wow, a third of the market.
Nearly a third of the value of the entire American stock market is tied to tech. And within the subsectors, the concentration is even more extreme. If you look at the communication services sector, 92% of that entire sector's weight is held by just its top 10 stocks.
So it's not a reflection of the broader economy at all. It's a reflection of a few dozen mega corporations. I look at this concentration, and it doesn't look like a healthy, functioning market. It looks like a life raft.
That's a good way to put it.
Investors are fleeing the burning ship of the traditional physical economy and cramming onto this tech life raft. And the sources point to Palantir Technologies as the prime case study for what they call the AI safety net.
Palantir is the perfect distillation of why capital is fleeing to tech right now. They released their Q1 earnings today and significantly beat Wall Street's expectations, posting earnings of 33 cents a share. Their stock is aggressively targeting a technical breakout between $153,000 and $165.
So why are they immune to the stagflation disease we just diagnosed the rest of the economy with?
Because of the specific mechanics of their business model, Palantir secures massive, deeply entrenched contracts to provide AI infrastructure and data analytics to governments and major industries. Our sources note they just locked in a $300 million blanket purchase agreement with the USDA.
The Department of Agriculture.
Yes, alongside a major production planning partnership with Cleveland-Cliffs, which is a massive steel producer. Now, once Palantir's software is integrated into the nervous system of an organization like the USDA or a steel manufacturer, the switching costs to remove it are impossibly high. Furthermore, their gross margins on software are massive.
Right, because once the software is built, the cost to replicate it for a new client is essentially zero. They aren't buying physical steel or shipping physical goods on cargo ships through the Strait of Hormuz. They are immune to the raw material cost explosion we saw in the ISM data.
Precisely. They generate massive amounts of free cash flow. They're actually guiding for nearly $4 billion in free cash flow for fiscal 2026 alone. Companies like Palantir, Micron, Oracle, and SanDisk, which all performed exceptionally well today, by the way, they are flush with cash. They don't need to borrow money at 6.5% from the bond market to survive. They are totally self-funding.
This creates a really profound disconnect. Because while the tech sector builds its impenetrable fortress, the traditional physical economy is not just battling inflation, it is now actively stepping into a massive, multi-front trade war. We have to unpack the sudden collapse of the Turnberry Agreement.
Yeah, this is where the geopolitical and economic risks really compound. On May 1st, just a few days ago, President Trump abruptly tore up the Turnberry Agreement. This was a critical bilateral trade deal that had capped import duties on European-made cars and trucks at a manageable 15%.
And he just ripped it up.
He ripped it up and immediately slapped a punitive 25% tariff on all EU autos, alleging that the European Union was failing to comply with the terms and deliberately delaying legislative ratification.
You don't just slap a 25% tariff on one of the largest automotive manufacturing blocks in the world without immediate violent retaliation. The European Commission is already threatening massive reciprocal tariffs on U.S. goods, and the corporate fallout is happening in real time. Volkswagen is bracing for an immediate $1.3 billion hit to their bottom line.
That's a staggering number for one company.
Yeah. France's primary stock index, the CAC 40, dropped 1.7% today, specifically because of the exposure of their industrial sectors to this sudden trade war.
So you have Europe sinking under the weight of surprise auto tariffs. You have traditional American industrial giants like Boeing and 3M struggling to manage the exploding costs of physical supply chains. The traditional global economy is visibly fracturing.
And yet, on the exact same day, the South Korean Kospi Index, their major stock market benchmark, surges 5.1%. Why? Not because they build great ships or cars, but specifically because their domestic tech firms announced new AI partnerships with U.S. tech giants. Are we fundamentally looking at a reality where there are two completely different global economies operating simultaneously on the exact same planet?
We basically are. In institutional finance, the technical term for this behavior is idiosyncratic risk management. But practically speaking, it is the bifurcation of the global economy. Major institutional investors look at the world right now and they see a geopolitical nightmare.
Right. War in the Middle East threatening oil, stagflation destroying consumer purchasing power, and trade wars fracturing relations with Europe.
So they are terrified of holding traditional industrial, manufacturing, or consumer discretionary stocks.
So they just park their billions in the AI safety net.
Yes. They pour all of their capital into mega-cap tech and AI infrastructure. They believe the tech sector's high margins and lack of reliance on physical supply chains provide an invincible moat. But this creates a terrifyingly fragile equilibrium.
Because it's all propped up on one leg.
Exactly. The overall S&P 500 index looks healthy because that 32.9% tech weighting is surging so violently that it masks all the decay happening in the other 67% of the market. If the promise of AI stumbles, or if those tech earnings miss by even a fraction, That life raft pops and the entire index collapses.
Which brings us perfectly to the ultimate symptom of this deeply distorted, bizarre economic environment. When capital allocation becomes completely untethered from physical reality, and when companies are desperate for growth but handcuffed by high interest rates, you get the most mind-bending corporate headline of 2026.
It really is wild.
GameStop is attempting to buy eBay.
It is a story that basically forces you to question if the market has totally lost its grip on fundamental math. But it is also a perfect reflection of this systemic desperation disguised as innovation.
Let's meticulously break down the mechanics of this proposed deal because the numbers are just staggering. GameStop, the video game retailer that became the face of the whole meme stock revolution a few years ago, has made an unsolicited, hostile $56 billion bid to acquire the foundational e-commerce giant, eBay.
$56 billion.
GameStop is offering $125 per share. To put that in perspective, that represents a massive 46% premium over what eBay's stock was trading at before these rumors leaked.
And the financing structure is where the audacity of the deal truly reveals itself. To fund this $56 billion acquisition, GameStop proposes paying 50% in cash, roughly $28 billion, and 50% in newly issued GameStop stock.
Hold on, GameStop doesn't have $28 billion in cash sitting in a checking account. How are they funding the cash portion?
They don't. They have secured a commitment for $20 billion in massive debt financing backed by TD Securities, and they are leaning heavily on the inflated value of their own stock as collateral.
I look at the market capitalization, the actual total value of these companies, and it feels like a minnow trying to swallow a whale. GameStop is currently valued at roughly $12 billion. They are trying to orchestrate the takeover of a $46 billion company. What on earth is GameStop CEO Ryan Cohen's actual strategy in here? How does a brick-and-mortar video game retailer digest an e-commerce pioneer like eBay?
The strategy, at least on paper, is entirely focused on logistics. Cohen's stated rationale is that he wants to weaponize GameStop's existing physical footprint. They have roughly 1,600 physical retail store locations distributed across the United States. He doesn't view them as stores anymore. He views them as nodes in a distributed network.
So he wants to convert them.
He wants to convert those stores into intake, authentication, and localized fulfillment centers for eBay's massive marketplace.
So wait, if I want to sell a rare collectible or like high-end electronics on eBay, instead of shipping it to a centralized warehouse, I drive down to my local strip mall, drop it off at GameStop, they authenticate it on the spot, and manage the logistics from there.
Which, to be fair, is not a purely theoretical concern. Our sources know that Amazon is currently crushing traditional legacy carriers like FedEx and UPS by aggressively expanding its own end-to-end, hyper-localized logistics services. Cohen is betting that integrating eBay's digital marketplace with GameStop's physical footprint creates an entity capable of surviving the Amazon juggernaut.
That sounds good on a pitch deck, but Wall Street analysts are looking at the math and screaming that the emperor has no clothes. Colin Sebastian, a prominent analyst at Baird, released a scathing note warning about the mechanics of the stock portion of the deal. To fund the $28 billion in equity they promised eBay shareholders, GameStop would have to issue over $1 billion entirely new shares of stock.
And the concept of dilution here is catastrophic for existing GameStop investors. If a company suddenly issues 1 billion new shares out of thin air, the slice of the pie owned by current shareholders becomes microscopically thin. The underlying value of their investment is destroyed to fund the acquisition.
And the high-profile money is already fleeing. Michael Burry, the famous investor who predicted the 2008 housing crash and was profiled in The Big Short, publicly derided the proposed acquisition as pedestrian. He didn't just criticize it, he immediately dumped his entire position in GameStop stock. He wants nothing to do with this level of financial engineering.
But the most telling metric of all, however, is how eBay's stock reacted to the news today.
Right, because normally it shoots up.
In a healthy market, if a company receives a legitimate buyout offer at $125 a share, that company's stock price will almost immediately shoot up to sit just below that offer price, maybe $122 or $123. The market prices in the expectation that the deal will close.
But that happened today.
Not at all. eBay shares only rose about 5% today on the news. They are still sitting roughly 12% below GameStop's offer price. That massive 12% gap represents the market's profound disbelief.
They just don't buy it.
They don't. The institutional capital looking at this deal does not believe GameStop can actually secure the funding, survive the regulatory scrutiny, or execute the merger without collapsing their own stock price in the process.
So what you're identifying is a fundamental breakdown in how capital is deployed right now. GameStop's core retail business of selling physical video games is structurally declining. In a stagflationary environment where consumers are broke and borrowing costs are 6.5%, they cannot grow organically. So out of sheer desperation, they attempt to use the hyperinflated meme stock currency of their own valuation to buy a massive, established cash flow engine like eBay. It's basically a magic trick to change their narrative because their fundamental reality is too grim.
It really is the ultimate reflection of May 2026. When traditional growth is suffocated by inflation and high interest rates, corporate entities resort to wildly ambitious, deeply speculative financial engineering just to survive.
Let's zoom out and recap the sheer, dizzying velocity of the chain reaction we've just unpacked today,
Yeah.
because it's all connected. We started with the tactical reality of a U.S. Navy destroyer deploying defensive munitions to sink a small, fast boat in the Strait of Hormuz.
Right. And because of that specific kinetic action and the unsurveyed sea mines validating the reality of the blockade, the global supply of energy is threatened, causing the price of Brent crude oil to violently spike over $114 a barrel.
And because the foundational input for the global economy jumped by 40% in a matter of months, U.S. manufacturing costs skyrocket, triggering the worst stagflationary signals in the ISM data we've seen in decades, crushing employment while prices surge.
And because inflation is stubbornly stuck at 3.5% and rising, the incoming hawkish Federal Reserve Chair, Kevin Warsh, is stripped of his ability to lower interest rates, forcing the bond market to price in a future where the cost of capital remains punitively high.
Because traditional borrowing and manufacturing are now toxic, institutional investors panic and bifurcate their portfolios, fleeing the physical economy to hide their billions in a handful of high-margin AI tech stocks like Palantir.
Which creates a stock market so top-heavy, distorted, and starved for traditional growth that a $12 billion retail chain feels mathematically empowered to attempt a hostile, debt-fueled takeover of a $46 billion e-commerce pioneer.
It is one single, continuous, highly volatile ecosystem. You pull a thread in the Persian Gulf, and a mortgage rate spikes in Ohio, while a tech stock surges in New York.
It's all connected. But if we follow that thread to its logical conclusion, there is one deeply impactful, lingering reality buried in our source material that extends far beyond corporate mergers or bond yields. It's the silent crisis that the market hasn't fully priced in yet.
Wait, what's the silent crisis?
It's the agricultural link. You see, the Persian Gulf doesn't just export the crude oil that refines into the gasoline running our supply chains. The region is also one of the world's most vital exporters of natural gas. And natural gas is the absolute foundational feedstock required for the chemical creation of global nitrogen fertilizers.
Oh, wow. The raw material required to literally grow the world's food.
Yes. Our commodity sources are already tracking a subtle but positive money flow into agricultural futures contracts for corn, wheat, and soybeans. The institutional smart money is looking past the immediate oil shock. If Project Freedom escalates from a localized blockade into a prolonged, entrenched regional war, it's not just the energy supply that gets severed. The global fertilizer supply chain collapses.
That's terrifying.
I want you to ponder what happens to the baseline cost of human survival if the 2027 crop season is starved of the nitrogen fertilizer it needs because of the naval clashes happening in the Strait of Hormuz today. Stagflation is painful when it limits your ability to buy a television or finance a car. It becomes a catastrophic, destabilizing force when it doubles the price of a loaf of bread.
That is an incredibly sobering thought to leave on. That the warning lights flashing on the economic dashboard aren't just signaling a tough quarter for Wall Street, they're actively warning us about the fragility of the global food supply. It proves how deeply reliant we are on systems we barely understand until they begin to break. Thank you for joining us on this incredibly complex deep dive today. We encourage you to keep questioning the headlines, to look past the surface noise of the political rhetoric, and to always search for those hidden, invisible connections driving the reality of our global economy. Until next time, stay curious.